Welcome, everyone. So good to see everyone today. Thanks for joining us. My name's Rachel Evans, and I'm calling in from South Africa. So joining those on the other side of the globe today, staying up a little bit later. But wherever you are, thanks for taking the time to be here and joining at our monthly Discovery Dialogue. So this is the second one we're hosting. We had our first one in January, and today's topic we'll be discussing a non-Newtonian response to inflation. So looking forward to diving into that topic with our guest speaker just now. I just wanted to set the stage for today of the flow. So we're going to have a discovery dialogue with our guest speaker. We're just waiting on him at the moment. He was at a lecture just before this, so he should be joining us shortly. I'll just give you a quick intro on his bio. It's been available on our website and emails, but I thought I'd give you a short version and you can always find the full one later. So Wray is a professor who has lectured at different universities in the States and has also traveled worldwide as a guest lecturer. Randy is an author, and his latest book is called Making Money Work for Us. He's also co-authored a textbook called Macroeconomics. He's the 22 Vemlin Comms Award winner for the lifetime contribution to institutional thought. So just really looking forward to the wisdom that he has to share with us today, and grateful to be here with everyone and the rest of the team. So I'm going to hand it over to John.
Thanks, Rachel. This is the part where I start doing the rabbit show because Randy hasn't yet entered the room, but I'm sure he's coming. We just spoke to him yesterday, and as Rachel said, he had a class just before, so maybe he's running a little late. I'll add a little bit to the introduction, give you a little bit of context. I first met Randy at the opening and first INET conference, the Institute for New Economic Thinking, which is run by my friend Rob Johnson and is funded by Soros and was a response to the financial crash, and is now a major global think tank wrestling with the future of economic thinking. And Randy was there representing his unique perspective on economics. He's part of this now increasingly well-known tribe within the radical economist community known as the modern monetary theorists. And as I mentioned in the invitation, Randy literally wrote the book on modern monetary theory. And he's a super bright guy. He was a disciple of Hyman Minsky, who some of you will recognize is famous for the Minsky moment, which is when financial markets sort of become self-fulfilling, and complacency breeds risk, which breeds extended risk positions, which then accentuates the ultimate crash in cycles. And the 1987 stock market crash, and more recently the financial crisis in particular, are kind of exhibit A of what Hyman Minsky anticipated and predicted, very contrary to the conventional neoclassical economic assumptions, which presume that markets move toward equilibrium. And so, at any rate, if Randy makes it, it'll be terrific for him to be with us. Again, while we're waiting.
Sorry. Keep going. No, that's fine.
Again, while we're waiting, just for those that are new to this, we call these discovery dialogues, and the idea of dialogue is not a conventional debate or even a conventional interview. The die part of dialogue relates to or means the word through. So the idea of a dialogue is to gain new meaning through the discussion. And an ideal dialogue will involve, tens or many more people than two. And so our hope in these dialogues is that we'll come to some new understanding, in this case, both Randy and I and all of you together, about inflation through the dialogue process. And the final thing I had to say as sort of anticipation, I'm just double checking my phone here. The final thing I wanted to say just in preparation is that there's sort of a conventional mainstream view on inflation. And so think of that as one perspective. Another perspective would be to try to think about inflation through our new regenerative lens. And that's the perspective that I'm going to enter into the conversation. And the third perspective, which is quite radical, is this MMT perspective. And so the one school of thought you're not going to have on this dialogue is the conventional one, but you're going to have two very unconventional ones trying to make sense of the current inflation and inflation in general. But I am now growing a bit anxious that maybe something happened to Randy because we haven't heard from him. I trust Rachel.
John, yeah. While we wait, I think it would be wonderful if we can maybe just touch on the foundations of the Newtonian approach and what it is. I feel like you can really speak to that and just speak to the foundation maybe while we wait.
Okay, yeah, and I can do my best to describe the foundations of MMT, which was going to be the first discovery dialogue subject that I was going to go through with Randy. So that's a good idea. So when I use the term Newtonian, what I mean by that is that conventional economics, and for those of you that have been through our course, you've heard me say this, is rooted in a foundation or on a foundation of Newtonian physics and a series of assumptions that take the Newtonian understanding of the laws of nature, of physical laws of reality, and apply them using simple assumptions to create laws of an economic system. And of course, during Newton's time, we didn't understand the concept of complexity. So there was this understanding of simple cause and effect. And that, in my mind, very much describes the way conventional economic thinking manages monetary policy. In particular, we have this premise that there's a trade-off between inflation and full employment. So as the labor market heats up, unemployment rates go down, more and more people are employed, less surplus labor in the labor market. That puts wage pressure on prices, and eventually causes prices to rise because of a scarcity of labor. And the Newtonian response to that is to raise short-term interest rates to quote unquote cool the economy. And so the premise is that if the economy heats up too much, inflation will follow, and we need to raise interest rates to raise the cost of money, which will, all else equal, shrink the aggregate demand and loosen up the demand for labor, and therefore ease the inflation pressures. And what you're seeing right now with the Fed raising interest rates in response to inflation is exactly that Newtonian sort of assumed single cause and effect response. Now, I see Randy has just entered the waiting room, so we're good. Yeah. Now, the Fed are not stupid people. They understand that by raising interest rates, it's sort of like taking a club and will have all kinds of consequences. But they're limited because that's their primary tool. And so they are essentially raising interest rates with the understanding that they're going to cool economic growth and potentially put the economy into recession. And they're trying to ride that delicate line between slowing economic growth, but not forcing the economy into a recession. And so that's sort of the conventional, what I would call Newtonian approach. And just in right timing, I think Randy is here somewhere. So if you are here, Randy, maybe if somehow you can jump to the top of my list. So I can say hi. There he is. Hi, Randy.
Hello.
Nice to be with you. Everything okay?
Yes. Sorry.
No problem. I was
Confusion.
doing my dog and pony show, rabbit show. So. Anyway, I've sung your praises, Randy, as literally the man who wrote the book on modern monetary theory, and gave a little bit of context setting, which we shared yesterday, so I won't repeat it.
Yeah.
And what I thought we would start with, again, many people here will not be expert at all in modern monetary theory. Some may have never heard of it. So while we don't want to talk about modern monetary theory too much, please, let's just start with sort of the real basics on what it means and what its radical implications are.
Okay. Well, it's, I suppose, a very different view of the way that the currency system works in what has been called a sovereign currency nation. But all we're talking about is a country like the United States, the UK, China, Japan, and so on, that issues its own currency, doesn't promise to convert it to gold, like on the old gold standard, doesn't promise to convert at a fixed exchange rate to any other currency. And we argue that we have to analyze these very differently from the way that we would analyze a firm or a household, because these are currency issuers. And we should see a firm or a household as a currency user. And so, when a politician says that, if I ran my household budget the way the federal government runs its budget, I would go bankrupt. And that surely is true. And it's also true that firms can go bankrupt if they get too deeply into debt. But that is not true for a currency issuer, for a sovereign government. And so we view their, let's say, affordability in a very different way for a sovereign government. A sovereign government, the United States could run out of unemployed labor once we put everyone to work. We could run out of particular kinds of resources, once they are fully put to work. But we cannot run out of money. And what that means is that the government can always mobilize unemployed resources by directing its spending toward them. And we don't need to worry about the budgetary outcome, which is always calculated after the fact anyway. So at the end of the fiscal year, they will tally up the spending of the federal government. They will tally up the tax revenue. They will subtract, and they will announce, well, our budget deficit over this past year was $1 trillion. But that is ex post. And over the course of the year, we don't really know for certain what the budgetary outcome will be. We spend, we tax, and then at the end of the year, we tally it up. There is no difference day by day in the way that the government finances its spending, whether we end up with a balanced budget at the end of the year, a budget surplus at the end of the year, or a budget deficit at the end of the year. The spending will always look the same. It always takes the form of keystroke credits. And we can go deeply into, get what gets keystroked. But it's a keystroke credit. And tax revenue is just a keystroke debit. And every day, there are millions and millions of dollars that are keystroked into existence by government spending, and some other number of millions of dollars that are keystroke debited every day of the year. And at the end of the year, we count up all the keystroke credits and all the keystroke debits, and we announce what the budgetary outcome for the year was. So this is important because many people think the government does something special in order to deficit spend. Okay, when MMT has been in the news a couple of times in the past 10 years. One was during the global financial crisis and the huge response, mostly by the central bank, to the global financial crisis, where they keystroked credits. The total, if you count all the keystroke credits that the Fed made in order to rescue the global financial system, the total is a really shocking number. And I'm sure this is going to shock everyone there, unless they have read our reports. It's 29 trillion.
Really? I was guessing 14 trillion.
That number was floated. If you count all of them, though, including that could be only to private domestic banks. Huh. That would be approximately the right number. But we keystroke credit to all the major big foreign banks and also to central banks. And the biggest one was the ECB. Mm-hmm. Count all those as 29 trillion. So Congress asked Bernanke, is that taxpayer money you're spending? And he said, no, we have this modern device called a computer. We keystroke credits, okay? So that's how we dealt with the global financial crisis. Yeah. For the pandemic crisis, it mostly was the Treasury, not the Fed. The Fed had some interventions too. Mostly it was the Treasury. And in that case, 9 trillion was allocated. 5 trillion was the relief payments that we all got. $5 trillion. Where did it come from? Keystrokes.
Yeah, and the amazing thing is that before all that happened, you had, the politicians on both sides of the aisle, obviously perhaps more so on the Republican side in the United States than the Democrats, but it was both sides arguing we needed to, quote, balance the budget.
Yes.
And in fact, Bill Clinton famously, for the first time in recent memory, balanced the budget and actually ran a surplus.
Yes.
And one of the things that blew my mind when I first got to know Randy and his colleagues in the MMT community is they point to the Clinton surplus back in, I don't know, it was 1993 or something like that?
97 to 99, 2.5 years.
So that surplus, the MMT folks will argue, was actually the cause of the next recession, because there's this accounting identity that says if the public sector runs a surplus, the private sector, which is individual households and firms, by definition needs to be running a deficit. And as Randy mentioned earlier, households can't run a deficit indefinitely because they go bankrupt, unlike the public sector. So, this conversation, we could spend the whole time just talking about MMT and its radical implications. What I would ask everyone to do, if this is sounding too mysterious and strange and can't be true, is just hold that mystery for a moment. Read Randy's book, come join our course. I've wrestled and questioned with this for years until I couldn't deny it, because it's so counterintuitive. But the point that Randy made at the beginning, which is that governments that issue their own currency are not like the rest of us, is the fundamental insight. And yet our political debate, about we need to balance the budget or we're running too big at deficits, is all either ignorant of that or intentionally, willfully denying that. And I suspect my opinion would be it's mostly ignorance, but I don't know if, Randy, your experience would tell you something differently. I think the central bankers understand it, but the politicians don't. And it's profoundly important. Would you agree with that, Randy?
We over the past 25 years, sometimes we will get meetings with elected representatives, and we will explain this. And some very prominent people have said, toward the end of the meeting, I get it. I understand what you're saying, but I cannot say that in public.
Yeah. Right.
So yes, I think there are a fair number of people. I testified before the House Budget Committee at the invitation of the chair, John Yarmouth. And I met with him before and after. And he said, the Democratic side of the Budget Committee, and remember, all the dollars that are spent go through the Budget Committee, right? He said the Democratic side understands this. However, he's the only one who came out in public and endorsed absolutely, no question whatsoever, MMT. And as good of an understanding as you can have, he did it in public. The others, for the most part, still have not. Yeah. But they do understand it.
And it is the premise behind the Green New Deal spending and a lot of these big, probably the Inflation Act, I suspect, even though, as you say, they don't say it. So at any rate, let's leave this. Well, one final thing I'd say is I think it's misnamed because it's not really a theory. It actually is this practical, mechanical reality of how money works. And so don't be misled by the term theory. It's not a theory in the sense of needs to be proven. It actually is mathematics more than it is theory. But the implications are profound. And one of them is in how we think about inflation and how we respond to threats of inflation, or whether we even care about inflation. And so that's really the topic that I want to dive into now, Randy. We'll share in the I don't know if we can do it if Rachel has it, but Randy wrote a beautiful one-pager on sort of an MMT response to the current inflation. But let's just talk about the current inflation, Randy, and what do you see as the causes of it before we get to what a more intelligent set of remedies might be.
Well, so MMT was in the news when the relief packages were passed. Say, oh, now we're going to do MMT. We're going to mail out checks to everybody. Well, this actually was not our recommendation. And I think you saw a one-pager that we wrote in March of 2020 arguing, don't do that. We should target the spending very carefully because the last thing we need is a fiscal stimulus when the supply side has crashed. If people can't go to work, you can't produce goods and services, it doesn't make sense to try to stimulate the economy. We argued for targeting the spending to people who could not go to work, who had bills to pay, who needed to pay their rent. Let's target the spending to them to get us through this period and tackle the health pandemic. So spending in the areas that would actually help us tackle the pandemic. And, relief, not stimulus, is what we needed. However, what we got was checks going to everybody. And the first round were used to pay bills and to increase saving. People like me who worked from home, I didn't lose any pay, so I increased my saving. By the time the second round of relief checks came around, there was less uncertainty. People were starting to go back to work or starting to go back out in public, and they started to feel more comfortable about spending. And so that second round got spent, but in unusual ways because you couldn't go to restaurants. You mostly were going to buy the kind of stuff that Amazon would deliver to your door.
Mhm.
And so we started getting shortages because a lot of that stuff is made in China. And China, was much more serious about locking down than we were. And so you started getting price increases, not too surprising. So to some degree, the problem
Actually exacerbating the price increases caused by the initial
that's right.
lack of supply. So you've thrown fire on the gasoline on the fire.
And, because people had stopped driving early on, the production of oil went down. And I guess they decided it was a good time to do maintenance activities to the refineries. And so when people started driving again, they couldn't ramp up the production enough, and maybe they didn't want to too, because they were going to take advantage of higher prices.
Right.
And so oil prices went up a lot. And when oil prices go up, it's always going to feed through. This is the third time where we've had a big increase of the price of oil. And that always feeds through into the price of everything that is shipped and everything that involves petroleum. 70% of the price of food is petroleum. Transportation, fertilizer, and the pesticides. So that feeds through. So we get a spike in oil prices and a spike in a lot of the kinds of things we buy that is really a supply side problem, not a demand side problem. But we decided to fight it as if it were a demand side problem, as if our problem was the economy was overheating, which it was not. And still is not, in my opinion. And the effect of interest rates is not helping us deal with the supply side problems. It doesn't make oil cheaper. It doesn't make food cheaper.
Right.
And it doesn't make housing cheaper.
Right.
And those three items are driving the CPI, the Consumer Price Index,
right.
just as they drove them.
Randy, I mean, if I can just jump in, there's, if you tune into CNBC or, any kind of stock market, banter and hear what all of the quote investment professionals are saying and all the big shot hedge fund managers, everyone joined this narrative. And, and the crypto boom took off because we were printing too many dollars. We were debasing the currency. Billionaires made more money speculating that the inflation would trigger the Fed to raise rates. They called for the Fed to raise rates, and the Fed followed suit and did just what the narrative said they needed to do. And what you're sharing, which to me makes total sense and is in alignment with looking at this challenge through a regenerative lens, because in a living systems framework, we understand complexity and we understand that there are no single cause and effect, and that everything is connected to everything. So that if you have the events that you just so nicely described, you're going to have a spike in oil prices, and that's going to cause inflation, and that's going to cause the Fed to increase interest rates, which is going to cause other current countries to have to increase interest rates to defend their currencies, which is going to trigger a recession, which is exactly what no one wants to do in the first place. And so it's sort of this, it's like insanity. Like we run the world on a framework that's like objectively and obviously fatally flawed. And yet these are all smart people. They're not stupid, ignorant people, but they're following a narrative, a playbook that is patently incorrect. Is that a fair statement?
Yes, and even within the Fed, there are researchers who are saying exactly what you just said, that nobody thinks through this clearly, and that the interest rate, the whole philosophy of the way the interest rate is supposed to cool the economy down, it is not theoretically sound and not empirically sound. People inside the Fed say this, research papers. So what has happened since the days of Ronald Reagan is that fiscal policy has taken a back seat when it comes to the macroeconomy.
Right.
So we have moved from the old view that you could use fiscal policy to try to keep the macroeconomy on course. You want high employment, but you don't want too much inflation. So that was what fiscal policy was supposed to do. And we've transitioned to, no, that's the Fed.
Yeah.
The Fed is going to keep the macroeconomy going fine. And fiscal policy is just going to focus on trying to balance the budget. Okay. And the problem
is errand to begin with.
Yeah. The fiscal policy.
We have fools implementing a fool's errand.
The fiscal policy has lots of tools and they can be very well targeted.
Yeah.
Okay. So we need more low-income housing. We have a huge housing shortage in the United States, which is driving up rent and adding to inflation. What can monetary policy do about that? Well, they're raising interest rates. That doesn't help at all. We could spend and start investing in low-income housing using fiscal policy. The Fed has one tool, and it's the overnight interest rate. That is it. That's all it can do. And so it's raising that. And that tends to raise all the other interest rates. And so it gets more expensive to build houses. How can that help us?
Let's expand. I mean, I think we could, we could hammer on this inflation issue, I think, for the rest of our little chat. But maybe let's just expand the conversation a little bit. What about? Well, before I go there, let's also contrast between what the United States can do and the U.S. Federal Reserve as the dominant world currency on the one hand. Contrast that with, say, the UK, which has its own currency, but is certainly not a world power like the US, and the currency isn't as strong. And then contrast that with, say, Brazil or Argentina, or a country that has its own currency, but obviously is in a much different position. How do we think about those differences?
Okay, so yes, the way I described a sovereign currency country, we would include Brazil in there, and we would include many developing smaller economies, less rich countries, as having their own sovereign currency. And what that means is they can mobilize their own domestic resources. So they can spend to get their own workers employed, to get their own factories, whatever they have, operating near to capacity. And to grow as much food as they can, okay? They can mobilize their domestic resources. And that's true of all of us. That's also true of the United States. The difference is that we can also use the dollar to mobilize foreign resources. And that is because there's a huge global demand for US dollars. The US dollar has become the main international reserve currency. Before us, it was the UK. So it was the pound that everybody wanted. Now, most of your portfolio is going to be in dollars. You're still going to have a portfolio in pounds, a portfolio in yen, a portfolio in euros. So there's a foreign demand for all of those. But the US is the dominant one. But all of us who have an external demand for our currency can use that currency to mobilize foreign resources. And we do that all the time. We're an importer, right? We are mobilizing resources in China to produce consumer goods that we buy in the US. We can mobilize Chinese workers to produce stuff for us because China wanted to accumulate US dollars, okay? And so our private markets are doing that. Our consumers are demanding Chinese products. But we also could use the dollars to benefit developing countries more directly. And that is that a developing country needs some imports. Lots of developing countries can't produce enough food. lots of developing countries can't produce their own energy. And developing countries need to purchase machinery from the developed countries. So they need imports. But there's not much demand for their currency outside their country. So they need US dollars and the other international reserve currencies in order to develop their economies so that they can become self-sufficient and so that they can raise their living standards and get out of poverty. And we can help them by sending aid. We can supply dollars not just by buying the output of a country like China. We can supply dollars to countries who cannot yet produce stuff that American consumers want to buy. So we can help them. And the US commits itself to providing international aid, and we never quite live up to even the small commitments we've already made. And the great fear is, well, that's going to bust our budget.
Right. It's incredible. I mean, we worry about, we make $100 million aid commitment to, say, Nigeria or a bunch of African countries, and then we worry that we can't fund it. And then, without looking, we print 19 trillion. I think you said. No, what was the number you said?
Well, that was 29 trillion.
$29 trillion dollars, and no one knows any different. But the implication, and Randy and I talked about this the other day, is that, to respond to the climate crisis, there's no reason why the US, given its position, can't literally just print into existence, keystroke into existence, the money at zero cost, not low cost, zero cost of capital to finance the expansion of solar energy across Africa, for example. And not only would that be good for Africa, that would be good for America and the whole world, because it would instantaneously, it would massively accelerate the transition off fossil fuels. And we can do that today, but we don't. It's literally incredible.
The danger, we can't run out of dollars. So forget that. We're not going to run out of dollars. The danger could be inflation. But if you think about helping an African country afford solar panels, the dollars are going to be spent importing what is needed for solar panels from a variety of countries, including China. It's not all going to be concentrated spending on US resources. So it's actually much less inflationary to send dollars to Africa to help them to develop
than to send them around the United States.
Around the United States. That's the point.
And the other difference, I think, Randy, between the MMT, at least where the MMT framework began, I know you guys have moved very much into this whole, ecological crisis thinking, but the presumption that exponential growth is physically possible on a finite planet is like a new ringer in the works, which wasn't really part of the original MMT thinking, I think it's fair to say. But I'm just looking at the clock. The chat is blowing up with comments. I'm sure there's questions that people would love to ask. So I'm gonna stop talking and turn it over to the folks here. And
John, Randy, any last thoughts, comments?
No, thanks. It was fun.
No, we're late on time, Randy. Just special thanks. It's great to reconnect after a while, and always insightful. And I look forward to continuing the conversation about how to integrate MMT and regenerative economics in an innovative way. It'll be fun and important.
Thanks a lot.
Thanks, everyone.